Swanand Kelkar, managing partner of Breakout Capital Advisors. They advise over $1.5 billion of capital into India and other markets. Joins us right now in our studios. Swanand, great having you. It's been a year and a half that you've been here, but thank you for joining in.
Thank you, Neeraj. This is always a pleasure.
The pleasure is entirely ours. So, Swanand, we were just talking to James Dorsey. He's a great thought leader on what's happening in the Middle East, and likely that there need to be off-ramps, but difficult to get them right now. If this conflict doesn't show signs of ending in the next 1 week, would you use the valuation argument to deploy capital, or would you be sitting on the sidelines waiting for the event to end?
So that's an interesting one, right? So thankfully, you have had an expert who's told you all about what's going on. So that sort of saves me the questions on Iran and oil and all those things.
No, we'll still ask you what you think.
For sure.
But let me tell you how we are thinking about it, right? So even within India, I think if you just look at the big picture, comparison versus emerging markets. So we have two funds in India. There is we have two funds. One is an emerging market fund and an India dedicated fund. So before this started, we had printed 2 years of single-digit earnings growth in FY25 and FY26, and we were being generally asked to pay 20, 22 PE for that type of an earnings profile. If you look at emerging markets, I think we'll probably have a 20% plus earnings growth here in 2026, and we were asked to pay 12 PE for that multiple, or for that earnings growth. So in that sense, the priority was clear on where you are going to allocate incremental time. That was the starting point even before all this started. And I don't think that has changed in a material way just because in a week's time. We are not thinking about what happens to the conflict, what happens to oil prices, etc., because we are deploying money for at least 3 to 5 years. Over the past many years in India, I would say that we have looked at many stocks and businesses and said that, hey, listen, this is not the price that we want to engage in. If this price comes to X, we will definitely consider this as a stock. Now, the fallacy that everybody has as an investor or a fund manager is that a price doesn't come to that level that you want it to on its own. It's generally accompanied by something which makes you stop in your tracks and say, hey, no, I need to wait a bit more. So what we have done over the past 1 week, right? I mean, I think that's important for some of your readers to, or some of your viewers to also know, is that we have not paid too much attention to the screen. We have said that, okay, we have probably looked at hundreds of companies over the past 3 years in India and overseas. Are some of them coming at prices which are attractive? And we are deploying in trickles. We are not deploying money lump sum because this is an event, you don't know what the end to that is. So that is what we have done, not only in this bout of volatility, but generally in all bouts of volatility. There is this person in our office who does not understand stocks at all. We look at a stock, it's at 500. We say that we would be interested in buying this at 350. When it's at 350, he sends an email to the entire system saying that it is at 350. What do you want to do about it? I think that's a very good way of thinking about it because you tend to get lost in the screen if you keep staring at it, and then somebody has to respond to it. Because it kind of, now you are being publicly asked this question, that the stock price is 350, what are you going to do about it? So that's what we have done, really speaking, over the past couple of weeks.
I'm wondering who is this person in your office?
So he deliberately is a person who's not part of the investment team,
okay,
who just runs an Excel.
As long as AI doesn't have his job anytime soon. No. Just on that point, and I like the thought of having focus no matter what's happening. But that confidence doesn't seem to be coming in on fundamentals in India.
That's right.
If on one day we say, okay, this is going to be behind us, what's happening in the Middle East, in Iran, etc., then we come back with, oh, but India doesn't have an AI trade. Yes. Does that bother you?
So it's a good question, right? So let's take this again. This conflict seems to be occupying a lot of our mind space. Just let's go a couple of 2-3 weeks back. As I said, the big picture construct in India versus emerging markets was clearly skewed towards emerging markets, as I mentioned. Now, there are several reasons why people attribute this underperformance to, but I think the core reason is that the earnings growth versus what is available elsewhere is not as attractive. That is the simple answer, right? And once that is happening, then you have ancillary, you start to think about ancillary irritants like there is no AI play, we do not have commodities, foreigners need to pay taxes. All these things are not new, really speaking, right, from an Indian standpoint. These are all, I would say, kind of backfitted answers. The core issue is that you are being asked to pay 21, 22 times PE for a 10% earnings growth. And that is just hard to hard to pay when other parts of the world are looking reasonably attractive. I think that's the core FII issue as well. So I'm sure at some point in time, why are FIIs selling? And I have had this discussion with n number of asset allocators. So I think the big hurdle is that, yeah, we understand the long-term story, great domestic market, there are enough and more themes. But for now, I need to cover my North Asia, which is Korea, Taiwan, China, not so much China, but Korea and Taiwan. And also India is not a beneficiary, unlike some other emerging markets, of the commodity event falls. So in emerging markets, sorry, just to digress a bit, there are two broad stories which are playing out. One is the AI beneficiaries. So the capex spending from the hyperscalers in the US, who benefits within emerging markets is the foundries, the memory, and all those things. And the other beneficiaries are countries which are net exporters of commodities, because commodity prices in general have done well, and that generally trickles down to the domestic economy over time. So if you look at South Africa, if you look at Brazil, large parts of Latin America, all that has done well. The AI beneficiaries in North Asia, which is Korea, Taiwan, they have done well. Unfortunately, India does not seem to be at the intersection or even partly in any of these places, which is why the FII interest could be at the moment lower. But the core reason which I mentioned, let's say we are here a year later and India has printed a 15, or we can see a 15-17% earnings growth. I would be surprised if the FII flows would still be negative.
But okay, but so the ancillary reasons still don't change, because I don't think in 1 year we'll become an AI beneficiary or the commodity boom either. So
Sure.
Where does this possibility of this 15 to 17% earnings growth come? Do you believe that, or is that the argument you're making right now?
No, so if you look at, so again, going back 3 months, right? Valuations are cheaper than 3 months ago. At least the growth green shoots are better than they were 3 months ago in India. Right? I mean, one of the biggest numbers there is the credit growth number, right? We were languishing at 10-11%. That number is now up to 13-14%. Given the amount of financials in the index, that number will lift the index earnings growth. Autos in general are putting out decent numbers, especially after the GST cut. So these are two big parts of the index which seem to have a reasonable lift coming through, and that should eventually feed through into the overall earnings growth number. So that is one part. So every analyst starts the year with the next 15 or the next 12 months number of 15%. So I know that's an old joke, but at least on the ground, looking at the high frequency indicators, it's not all gloom and doom. I mean, there are enough places where there is growth which is improving from what it was over the last 2-3 months, and valuations have corrected a bit. Have they corrected enough? I think that is, your guess is as good as mine, but they definitely have corrected from what they were 3-4 months ago.
Where are these pockets where you're seeing the positivity coming in? Which spaces in the Indian ecosystem right now are you watching? Because one part, we've spent some time talking about FIIs,
Sure.
but as far as domestic investors are coming, they seem pretty much locked in and committed.
Yes.
So for them, where are those opportunities?
I think that's the good part of it, right?
Yeah.
One of the reasons why we are at a 2021 P is because Messrs. Vasan and Navneet Munot have been continuously deploying capital in this market, and thank God for them. I mean, I wrote this in my year-end piece that you should count your blessings sometimes. As I said, right, the two broad sectors where I'm seeing in general an inflection upwards is credit growth and autos in general. Those are just broad sectoral.
So banks and autos.
Banks and autos are generally looking okay. When credit growth used to pick up in the past, we used to generally get excited, but this time around, there is a sort of a nuance there that even deposit growth needs to pick up in line with credit growth for you to be able to capitalize on that number as an investor. So that is something to watch, but both those places looking reasonably okay. Within autos, we've seen an uptick in commercial vehicles after, I think, I don't know how many years. And it's been the past 5, 6, maybe 3-4 months even, and we remain reasonably optimistic about that part. On IT services, I know again a contentious issue. We feel that the baby has been thrown out with the bathwater in certain cases. We are hopefully trying to look for those babies and get some of them.
Such a hard hunt? Because there are not so many.
No, so I'm not very clear that, so there are collateral damage candidates to, what's happening to IT services. I think we are first focusing there. Things like OTAs, things like maybe consulting companies listed overseas but have bulk of their workforces in India, etc., who seem to have been painted with the same brush as a normal software company. The issue with the Indian software companies is that if you look at similar business models overseas or in emerging markets, they're at 12 PE, they're at 10 PE, right? Which, as somebody who looks at the whole swath of markets, That's a question I ask myself, that you're essentially playing the same investment thesis. Do you still want to pay 20 PE for it, or do you want to pay 10 PE for it? So that's where I'm stuck on the plain IT services model. But there are some interesting models which have also gotten damaged because of, this whole vague worry that AI is going to eat up everything out there. So we are looking at that space. The one thing which you asked, the last thing I'll say, I know you have a few more questions, is does India benefit at all? I think we'll benefit from a bit of the tail end of that AI thing, which is the power and data center related investments and companies. But apart from that, we do not have some of the things that are leading the AI.
What about energy, Swanand? Because that sector in the last 12 months has gotten massively derated.
Yes.
Despite the fact that presentation after presentation from companies seems to point towards a fairly strong earnings growth, fairly strong cash flows as well. So why the derating, and are you using the derating?
So good questions again. So if you look at just the electricity consumption number, right, that is still broadly in line with the real GDP growth number. Right. So that hasn't picked up. We had an early monsoon last year, etc., etc. All these data centers that we are talking about will probably add a percentage or two over the next 3 to 5 years to the overall electricity demand growth. What is more exciting in that space, I think, is the capex plays around that. Because there is grid renewal, you need to hook up all the renewable energies now into the main grid, etc. So I think we are trying to look at those opportunities. Also, this grid renewal, which is a theme, is not just an India theme. Go to any place across emerging markets or even the US. I think every grid needs to be renewed. I mean, you have outages in places like Europe that, the Heathrow incident, etc., etc. So that is something that we are looking across emerging markets, including India, that can we find some good capex plays there?
We've not spoken at all about the Middle East crisis. So as we wrap up, I'm going to ask you from the point of view of the might of NRIs in these countries. So a few days ago, the whole conversation was, are Dubai family offices selling? And are they managing to shake up what's happening in Indian equities? The reverse also may be true. Are we sort of underestimating the contribution of non-resident Indians to equity markets? And when these regions shake up, so do their confidence.
Sure. I have no data to say yes or no, but it's a valid question. I think there are a couple of transmission mechanisms for this to happen, right? At a big picture level, the remittances, which is a big bulwark of what India gets from the Middle East and cushions our BOP, I think that can come under pressure if this sustains for a fairly long time. A lot of people have been evacuated, people are leaving the country, going back to their homeland. Can that impact remittances and hence the currency and hence the BOP situation? That's a question. We are just 8-10 days into this. Are the family offices, are people who are in Dubai, are they selling the Indian equity markets? I really don't have an answer to that. But a statistic which I find interesting is that across the globe, the retail ownership or non-institutional ownership of stock markets has gone up, be it in the US, be it in India, be it in most other large liquid markets, even in a place like Korea. So that has a different dynamic than how an institutional investor behaves sometimes, when a retail investor behaves differently a bit than how an institutional investor behaves.
Yeah, so we might see that play out. Interesting aspect, and I think the remittances aspect is one which we haven't fully understood.
We haven't. No, just to clarify, I mean direct retail ownership or retail ownership through mutual funds?
I mean direct retail
ownership.
Direct
retail ownership across worldwide has gone up.
So if you take the world market cap and if you split it the way we do in India, that how much is promoters, how much is foreign institutional, domestic and retail. So that last segment, the world over has gone up.
Interesting statistic. Okay. Well,
totally
not just
cool.
India.
Thank you so much, Swanand, for coming in. This has been a fantastic chat. Hope we don't have to wait another year to have you back in our studio.
Thank you so much.
Too much happens in a few weeks to wait that long.
We don't have a lot to say, unfortunately.
Right. So that was Swanand Kelkar for you.